Imagine this. It's October 1929 and you're sitting in a Manhattan brokerage office. The champagne is flowing. Your neighbor just bought his third car with stock profits. The shoeshine boy outside is giving investment tips. Everyone around you is getting wealthy, and the experts are declaring a new era of permanent prosperity. You feel invincible. Then, within days, it all collapses. Fortunes evaporate, banks close, lives are destroyed. And everyone asks the same question. How did we not see this coming? Here's the truth that will change how you see the economy forever. The moments when everyone feels most confident are precisely when you should be most afraid. The biggest crashes in history weren't random events. They were preceded by the biggest booms. And the pattern repeats over and over, from tulip bulbs in the 1600s to tech stocks in 2000 to housing in 2008. The details change, but the psychology stays identical. Welcome to Economic Mirage. I'm your host, and today we're uncovering one of the most dangerous patterns in financial history. A pattern so consistent that once you understand it, you'll never look at economic booms the same way. Before we begin, hit that subscribe button and turn on notifications. This channel exists to give you the financial education that protects your wealth. And if this video opens your eyes, drop a like. It helps us reach more people who need this information. Let's start with a disturbing fact. The greatest economic disasters are always preceded by periods of extreme optimism. When unemployment is low, markets are soaring, and everyone is spending freely, that's often when the foundation is crumbling. Why? Because that confidence is usually built on debt, speculation, and unsustainable leverage rather than real economic strength. Take the Dutch tulip mania of 1636. The Netherlands was experiencing its golden age. Amsterdam was becoming Europe's financial capital. Then tulips, exotic flowers from Turkey, became objects of intense speculation. At first, interest was reasonable. Wealthy collectors wanted rare varieties, but prices started rising and psychology changed. People bought tulip bulbs not for flowers, but to sell at higher prices. By 1636, a single rare tulip bulb sold for more than 10 times a skilled craftsman's annual income. That's the equivalent of a luxury Amsterdam home for one flower bulb. Workers mortgaged their houses to buy tulips. Futures markets emerged in taverns. Everyone was convinced they'd found easy wealth. The logic seemed perfect. Tulips were scarce, demand was high, prices had risen for months. Why would it stop? If you had warned in 1636 that tulip bulbs weren't worth more than houses, you'd have been laughed out of the room. The people making fortunes would have called you ignorant or jealous. Then, in February 1637, something shifted. Buyers disappeared almost overnight. Panic selling began. Within weeks, prices collapsed over 90%. People who mortgaged everything were destroyed. The Dutch economy fell into depression. You might think that was 400 years ago. People were less sophisticated. But the exact pattern has repeated constantly right up to today. Only the objects of speculation change. Fast forward to the 1920s in America. Following World War I, the country experienced extraordinary prosperity. New technologies were transforming life. Radio, automobiles, electricity. The stock market delivered incredible returns year after year. Between 1922 and 1929, stock prices nearly quintupled. Ordinary Americans became obsessed with stocks. Brokerage offices opened in small towns. People who'd never invested were buying on margin, borrowing money to buy stocks. The logic was simple. Stocks always go up, so borrowing to buy more was smart. Prominent economists declared America had reached a permanent plateau of prosperity. One Yale economist stated days before the crash that stock prices had reached what looks like a permanently high plateau. Newspapers celebrated secretaries and shoeshine boys becoming wealthy through stock tips. The message was clear: if you weren't in the market, you were missing the easiest path to wealth in American history. By summer 1929, stock valuations made no fundamental sense. Companies traded at price-to-earnings ratios of 30, 40, or higher, but traditional metrics were dismissed as old-fashioned. This was the new era. The rules had changed. Then came October 1929. The market didn't decline, it collapsed. On October 28th and 29th, the Dow fell nearly 25%. Billions in wealth evaporated in hours. People who bought on margin received calls they couldn't meet. Forced selling pushed prices lower, triggering more margin calls, forcing more selling. A death spiral had begun. Over 3 years, the market fell nearly 90% from its peak. Banks failed by the thousands. Businesses closed. Unemployment hit 25%. The Great Depression arrived, taking over a decade to recover from. This wasn't unforeseeable. Warning signs were everywhere. Valuations were detached from reality. Leverage was extreme. Speculation replaced investment. Skeptics were mocked. All the classic signs were present. But during the boom, those signs were invisible because everyone was making money. This reveals a fundamental truth. Economic booms and crashes aren't primarily about economics. They're about psychology. Human nature herd behavior, greed, fear, and the belief that this time is different. Once you understand the psychological patterns, you see them repeat throughout history with remarkable consistency. The mechanisms are always the same. First, there's genuine innovation creating real opportunities. Then, speculation takes over. Prices rise beyond rational valuation. Leverage amplifies gains, making everyone feel brilliant. A narrative develops explaining why old rules don't apply. Skeptics are dismissed. The boom becomes a bubble that must burst. The people at the top often know what's happening. They're not stupid. But they have incentives to keep the boom going. They profit from fees during the euphoria, warning people would end their profits. So they stay quiet or actively promote the boom while preparing their own exits. When the crash comes, these institutions often buy assets at fire sale prices, consolidating wealth and power. This isn't conspiracy theory. It's documented historical pattern. After every major crash, wealth becomes more concentrated. The wealthy who understood the cycle and prepared buy assets cheaply from desperate sellers. The middle class, entering late and exiting late, bears the losses. The wealth gap widens. So here's the critical question. If this pattern is so clear, why do we keep falling for it? The answer is both simple and profound, because during booms, warnings are dismissed as pessimism, and skeptics are attacked as people who don't understand that this time is different. Those four words, "this time is different," might be the most dangerous phrase in finance. Ready to learn the specific warning signs that appear before every crash? Welcome back. Now that we understand how booms precede crashes, let's explore something that could genuinely protect your financial future. The specific, identifiable warning signs that appear before economic catastrophes. These aren't subtle clues. They're glaring red flags that become invisible during euphoria. Learn to recognize them, and you'll have a massive advantage over the crowd. If you're getting value from this, hit that like button right now. It takes 2 seconds and massively helps this content reach more people. Every like tells the algorithm to share this with viewers who need this education. Let's continue. Warning sign number 1, when everyone becomes an investor. I'm not talking about professionals being bullish. I'm talking about universal participation regardless of expertise. When your hairdresser gives investment advice, when Uber drivers day trade between fares, when family dinners become investment strategy sessions, you're witnessing a classic warning sign. This happened spectacularly during the late 1990s dot-com bubble. The internet was genuinely revolutionary, no question. But what happened in markets went beyond rational assessment. Companies with no revenue, no profits, no realistic path to profitability were valued at billions. All they needed was a website and .com in their name. Let me give you a specific example that captures the insanity. In 1999, a company called VA Linux went public. On its first day, the stock increased 698%, not a typo. It opened at $30 and closed at $239. This company had $17 million in revenue the previous year and lost $7 million. No path to profitability existed under any rational analysis. Yet investors valued it at billions purely on belief that internet companies were the future and traditional valuation was obsolete. The media amplified this. CNBC became must-watch television. Day trading became a profession. People quit jobs to trade full-time from home. Books titled Dow 36,000 became bestsellers, arguing stocks were actually undervalued even at inflated prices. Anyone raising concerns was dismissed as hopelessly out of touch. Traditional investors like Warren Buffett, who refused to invest in unprofitable internet companies, were mocked as dinosaurs who didn't understand the new economy. Skeptics weren't just disagreed with, they were ridiculed. This is critical. When questioning the boom makes you a social outcast, when skepticism meets anger rather than debate, you're deep in bubble territory. Then came March 2000. The Nasdaq peaked just over 5,000. Over the next 2.5 years, it fell to around 100, a 78% decline. Trillions in wealth evaporated. Thousands of companies went bankrupt. Hundreds of thousands lost jobs. Retirement accounts were decimated. The people who mocked skeptics in 1999 were financially destroyed by 2002. Warning sign number 2, abandonment of fundamental analysis. During booms, people stop caring whether investments make economic sense. They stop asking if companies can generate profits or if asset prices are justified by income produced. Instead, they focus solely on price momentum. They buy because prices are rising and expect them to keep rising. This is the greater fool theory. You're not buying because the asset is worth the price. You're buying because you believe someone else, a greater fool, will pay you more later. This works until you run out of greater fools. And you always run out eventually. During the housing boom of the mid-2000s, this reached absurd proportions. People bought homes they couldn't afford with mortgages they couldn't repay, planning to flip for quick profits. The underlying economics didn't matter. Whether buyers could make payments long-term didn't matter. All that mattered was that housing prices had risen for years, and everyone believed they'd keep rising forever. The phrase, housing prices never decline nationally, became an article of faith, repeated by real estate agents, mortgage brokers, financial advisors, even regulators. It was built into financial models used by banks and rating agencies. The entire financial system was structured around the assumption that real estate was essentially risk-free because prices only went up. But assumptions everyone believes without question are usually wrong. And when they're wrong, consequences are catastrophic. By 2006, home prices in many markets reached 10 or 12 times median local income. The math didn't work. People couldn't afford homes at those prices based on incomes. The only way the market continued was through increasingly risky lending and the belief that prices would rise fast enough that affordability didn't matter. Warning sign number 3, extreme leverage throughout the financial system. When everyone borrows heavily to invest, when down payments disappear, when lending standards evaporate, the system becomes incredibly fragile. Leverage amplifies gains during booms, making everyone feel wealthy and smart, but it amplifies losses just as powerfully on the way down. Before the 2008 crisis, major investment banks were leveraged 30 to 1 or higher. For every dollar of their own capital, they'd borrowed $30. This creates enormous profits when asset prices rise by just a few percent. But it means a decline of just 3 or 4% wipes out your entire capital. Banks were making massive bets that housing prices would keep rising using borrowed money. At the consumer level, the situation was equally bad. Mortgage products were designed to maximize borrowing, not ensure people could afford homes. You had ninja loans, no income, no job, no assets, where borrowers didn't even prove ability to pay. You had adjustable rate mortgages with teaser rates resetting to unaffordable levels after a few years. You had interest-only mortgages where people never paid down principal, betting rising home values would build equity for them. The entire system was debt upon debt upon debt. It all depended on one thing, home prices continuing to rise. The moment prices stopped rising, the whole structure was doomed to collapse. And collapse it did. When housing prices peaked in 2006, the cascade began. Borrowers with adjustable rates saw payments reset to unaffordable levels. People planning to flip houses found no buyers. Defaults increased. Banks holding mortgage-backed securities saw losses. They stopped buying mortgages. Banks stopped making loans. Housing demand collapsed. Prices fell. Warning sign number 4, vilification of skeptics. During every boom, people raise concerns, analyzing data, pointing out unsustainable trends, warning about leverage and speculation. And during every boom, these people are attacked, dismissed, or ignored. Before 2008, economists and analysts sounded alarms about the housing market. They pointed out home prices had detached from incomes, lending standards had collapsed, securities created from subprime mortgages were time bombs. They were largely ignored or ridiculed. The financial media gave them minimal coverage. Industry insiders called them perma-bears who always predict doom. Regulators did nothing. One analyst betting against the housing market was told by a major investment bank, "You're wrong, and even if you're right, we'll make so much money in the meantime that it won't matter." Think about that. Even if skeptics are right, we'll profit so much from the boom that the eventual crash is worth it. This mentality drives these cycles. Warning sign number 5, financial speculation disconnected from productive activity. When the smartest people go into finance instead of engineering or medicine, when financial services represent huge percentages of corporate profits, despite creating little real value, when more money is made, moving money around, than creating goods and services, you're in dangerous territory. Before 2008, Wall Street had become a casino where banks made bets on bets on bets. They'd create mortgage-backed securities, then create derivatives based on those securities, then create synthetic derivatives that weren't even based on real mortgages, but just bets on performance of other derivatives. The complexity was intentional. It obscured risk and allowed banks to claim sophisticated risk management when really they were gambling with leverage. The final warning sign, the phrase, "This time is different." Every boom comes with a narrative explaining why normal rules don't apply, why traditional valuation is obsolete, why leverage is manageable, why skeptics don't understand fundamental changes. This narrative is always compelling, always backed by smart people with impressive credentials. And it's always wrong. These warning signs aren't hidden. They're obvious if you know what to look for. But during booms, they become invisible because everyone has incentives to ignore them. People making money don't want to believe the party will end. Institutions profiting actively promote it. Media covers success stories, not warnings. Ordinary people, seeing everyone getting rich, convince themselves the boom is real and sustainable.